Hi, my name is Rashaad Tayob, Portfolio Manager on the Nedgroup Investments Stable Fund. Today I'm going to give you an update on the portfolio for 2023 and how we're going to be positioned for the year ahead. Now, the goal of the Stable Fund is to deliver inflation-beating returns with a level of downside protection. Now, the fund has been around for more than 15 years, and in that time, we've never had a negative return over any rolling 12-month period. And our goal as portfolio managers is to maintain that track record. Now, 2023 was the year that the recession never arrived. You had a rate hiking cycle all over the world in 2022, and rates went from zero in the developed world up 500 basis points. And in that type of environment where you look at a global economy which has been dependent on ultra low interest rates for a very long period of time, since the financial crisis of 2008, it wasn't surprising that the expectations for a recession going into 2023 were very elevated. How do you take an economy so dependent on low rates, jack rates up, freeze the housing market, increase the cost of corporate borrowing, and not expect a slowdown? So the expectation was that the Fed would hike until something broke, and the thing that broke was the US banking sector in March of 2023. Now, while 2023 ended the year on a strong note, there were some very significant hiccups through the year. And in March to June, we saw the second, third, and fourth largest bank failures in US history, plus Credit Suisse also imploded in Europe. Now, the Fed was forced into action very quickly. They backstopped depositors. They launched new lending facilities, and in fact, they managed to paper over these problems quite quickly. And while Q2 and Q3 was a very difficult period, by Q4, the economy was back up and running. However, we still think there are significant fragilities in a banking sector which has a lot of unrealized losses, where capital is very depleted and their ability to lend is quite constrained. Now, how did the economy manage to maintain at these high level of rates with a diminished banking sector? I think the answer doesn't necessarily lie in monetary policy, which is what the Fed, with the Federal Reserve and other central banks do, but it depends on it depends on what was happening with fiscal policy, what the government's is the level at which the government is spending. And the US in 2023 delivered a fiscal deficit of $1.7 trillion. That is a massive number outside of a massive recession. It's higher than the numbers that we saw even in a global financial crisis. And when the government is spending this amount of money, when there's a constant level of fiscal stimulus, it's very difficult, even mathematically, to generate a recession. However, what you're essentially doing is kicking the can down the road. You're getting a massive build up, trillions of dollars of debt, which does cause significant risks down the line, and we have to be very aware of them. We have to be aware of the starting point. So if you're starting with a fiscal deficit of 5 or 6% of GDP, what happens if there's a recession and revenues come down, growth slows? That deficit is going to explode to levels that we've never seen before. So it's definitely a risk which has been kicked down the road, but is definitely still there. So because of all this government spending, what we saw in Q4, once things stabilized in terms of the rate environment and the outlook for rates basically peaked and people began to look to rate cuts in 2024, the equity markets performed very strongly. Developed world equities did very well, led by the Magnificent Seven, the tech sector in the US, but not exclusively. You had many developing markets around the world perform very well, emerging markets like India also doing very well. The laggard was China. The Hang Seng and Shanghai were rare negatives, and the reopening trade and the excitement about China reopening and the economy growing didn't materialize, and these economies ended up performing below expectations, and the equity markets were laggards. On the right-hand side, you see a chart of the US 10-year bond yield, and you can see that the yield ended basically exactly where it started. However, there was a period in the third quarter where the 10-year bond yield touched 5% for the first time in more than 15 years. And that was led by the fears around the massive amount of bond issuance that the US has to do because of the deficit that I talked about just now. Now, in South Africa, we know the effect that persistent deficits and persistent borrowing can lead to elevated bond yields. But in the last quarter, you saw the US Treasury take action. And instead of issuing more bonds into the market, what they did was they issued a lot more T-bills. So realistically, your funding strategy, if you're looking to fund a deficit, should be 80 to 85% bonds, 15% T-bills, which is your short term. That's a prudent way to run things. Now, they flipped that around at the end of last year, and they came in through with a strategy of issuing 60% in the short term. In the short-term treasury bills, and that took the pressure off the bond market and caused a massive recovery. And overall, bonds, while having been down for a significant period, ended the year relatively flat. So for 2023, we saw a very good recovery in developed market equities, driven by the S&P 500 and driven by the tech sector of the US. Developing market equities did okay. And South African assets, your bonds, your equities, and your property all did fine. The stable fund, I think, did well to outperform the range of asset classes in these environments. The Ford International Fund, which is a large part of our equity component, unfortunately was a laggard in 2023 after delivering a very good performance in 22. And that was because of its more value-orientated bias and not having enough exposure to the tech sector, but also having an overweight exposure to the Chinese sector, which didn't perform. However, if we look at a 2-year number, and we have to look at the longer term, 2023 was effectively very much a reversal of what happened in 2022. So 2022, you saw significant drawdowns, and 2023 for developed market equities was just a recovery. And in fact, if you look at developed market equities, if you look at bonds, if you look at property, those have still not recovered the significant losses that you saw in 2022. South African assets did reasonably well. The rand has consistently depreciated, and I think stable fund over 1 and 2 year periods has done well in both the negative environment of 2022 as well as the bullish environment of 2023. Now, where have these returns come from? One of the bigger drivers of returns was the fixed income component of the fund. It's a significant component. It did, and the high yielding nature of South African fixed income assets delivered good returns. A very good performer was our SA equity component, and the Ford team has done very well in 2023 in delivering a significant outperformance of the equity benchmark. So even though the equity component of the fund only averaged just over 10%, it was a significant driver of returns. Your offshore component is very large, and it did deliver a good return, but not necessarily. It was underwhelming relative to what happened in global markets. But I think going into this year, where there are still downside risks, I think it is very well positioned. And if you look at the longer term, over 1, 2, 3, and 10-year periods, the fund has done well relative to in delivering inflation plus returns, and it's done well relative to its peer group. Now, going into 2024, we saw a strong recovery at the back end of last year, but we don't necessarily think that recovery is built on very strong foundations. This chart shows a measure of fragility, which is a function of it's a sum of the fiscal deficit, how much the government is overspending, as well as the current account deficit, which is your gap between your imports and your exports. And if you are running deficits in either of these, you need consistent external funding. If you run a fiscal deficit, it means you need to issue bonds. You then are dependent on the bond market in order to finance your spending. It's not coming through from revenue. If you have a current account deficit, it means that you're importing too little, you're exporting too much. You're importing too much and you're exporting too little. It means that you are dependent on foreign flows to finance that deficit. And if you look at that around the world, so the world is a very imbalanced place. South Africa we are used to sitting to the left end of that curve because we run these persistent fiscal and current account deficits. But what's very surprising is where you find the mighty United States, the biggest economy in the world, is now in last place. And that is a function of a massive amount of overspending and a massive amount of imports. So we think that the US recovery is built on relatively shaky foundations. And while it did recover nicely in 2023, and going into the US election in 2024 with inflation coming down, and there's a good chance that interest rates come down and provide a bit of a boost to the US economy in 2024. But going into next year, and you have to always be forward-looking, we think that there's only so far you can kick this can down the road. We think the risks will build towards the end of the year, and it's something that we have to be very aware of, the fragility of the US system. The other risk we have to be aware of is the growing geopolitical risk. Now, over the last 10, 15, even 20 years, geopolitics and politics in general has been something that the market has been always been able to ignore. Regardless of wars, of terrorist attacks, whenever there was a dip in the market caused by politics, it made sense to buy, and you saw the markets rebounded very quickly. But if you look at some of the geopolitical risks that are building going into 2024, you're seeing the relative position of the US diminish. The US has been the major economic and military power since World War II. Its position is now coming into question. You've got war in Europe, and you've got China asserting itself as an economic power and also a military power in the East. And things are getting a bit messy. You're getting a period of deglobalization, which we think is very real, and therefore geopolitics is not necessarily something that you want to be ignore going forward. And the important thing about deglobalization is that it impacts your portfolio in two ways. Firstly, globalization has been very good in terms of having low inflation, open borders, open trade. It's been a deflationary effect on the world, with China the biggest manufacturer exporting deflation globally. If that goes into reverse, I think this very benign 2 decades of inflation environment will begin to come into question. You have to run with a bit more stickier inflation going forward. And then secondly, if you starting to put up trade barriers, if you're starting to sanction countries, then your potential growth of the world then comes down. And we have to be aware of these two impacts on growth as well as inflation can be negative for asset prices going forward. So if I look at the near-term outlook, the Fed, with inflation falling, has the potential to cut rates, and that is priced in at the moment. Rates are priced to fall by more than 100 basis points, 6 rate cuts being priced in. But there is a chance the market could be disappointed in 2024, and therefore we think it makes sense to be cautious. The Fed could definitely stay on hold, or the recession, which didn't arrive in 2023, could still arrive this year if the Fed doesn't cut very aggressively and high rates continue to take the toll. And in those type of scenarios, I think there's a potential for downside risk. On the South African side, something we're still paying close attention to is the debt problem, the debt buildup as we go into the budget in February, which is less than a month to go. Our debt has grown dramatically from under $1 trillion in 2008 to over $5 trillion, heading towards a $6 trillion level. There's no sign of constraint on government spending, and we've also got an election coming up where it's going to be very difficult to control the expenditure. So where your interest costs are heading above 20% of your revenue, we are in a very precarious position, and that's why you're seeing government look to use some of our reserves, tap into some of the savings that we have in order to fund our excessive spending. So while these are shorter-term measures, we still think that the problems are not necessarily fixed, and we need structurally higher growth in order to sort that out. If you look at the positioning of the portfolio, we have incrementally trimmed some bond exposure into strength. We've looked for high-yielding opportunities at the shorter end of the curve. We've added some inflation-linked bonds where your real yields are at very attractive levels. We've also increased the offshore component a little bit. 2022 was a year where we increased it very attractive attractive levels on the rand, and we continue to tick it up such that we stay close to that 45% offshore level, as we do see the risks in South Africa maintained at elevated levels. The commodity exposure is significant at close to 5%, and that's primarily by gold, due to our gold exposure, which we think has very good potential in an environment where geopolitical as well as debt risks continue to be elevated. So going into 2024, we think that asset prices are at risk after a very strong rally in the fourth quarter. Low inflation does provide central banks around the world room to ease policy, but will they do it in time, and will it be enough? Remember, rates are much higher than we've seen in the last decade and a half. Politics, as I mentioned, is building, and the SA economy remains structurally challenged with an inability to have a political and policy environment which is conducive to growth, and that's why we have a lack of investment. Bond yields are elevated, but in our view, you need a very high risk premium given the debt level, so these elevated levels of bond yields are likely to remain. But we do think that it makes sense to have some exposure given the overall yield, and physical gold, an attractive diversifier with upside potential given the risks out there. But at the end of the day, our game is to deliver inflation-beating returns with low level of downside risk, and therefore diversification is key, having a mix of different fixed income, equity, commodity type asset classes in order to deliver on our inflation plus targets. Thank you very much.